Hey, financial freedom seekers, Simon Dixon here, and what another week of drama we've had. So today I was going to be covering the topic of security tokens. I decided to do that as of Tuesday after attending virtually on Zoom the Celsius court hearing, where we had an update from Celsius, and it looks like the reorg plan is going to be centered around security tokens. So I've been working in that space for over a decade right now. I don't wish to toot my own horn, but I've probably got more experience in this field than anyone in the world. And I'll explain that for right now, all the different areas that we've been involved with and the different partners over the years. So when I heard that, immediately wanted to continue to introduce some partners that could help with that, because this is too important to get wrong, and I have seen what can go wrong. So I'm going to share that with you today. I've never actually given this content on some of the security tokens that I've invested in or worked in, and having learned the secrets of what went right, what went wrong. And so it inspired me to put together some slides, and I'll be covering that today. As always, we'll be doing an AMA afterwards on Twitter Spaces. But I'll jump right in, and I've got some slides together on that. So I'm going to break this into three. The first section, I'm going to be going through the latest in the Chapter 11s and why this inspired me to talk about security tokens. The second section, I'm going to be covering a few slides on the secrets of security tokens that have gone well and why what others went badly, and what that means. And then thirdly, I'll be covering for as long as I can on some of the leaked bids. So the story this week is a bit of a roller coaster, really. So we had the court hearing on Tuesday. And on Tuesday, I was biting my tongue while I heard Kirkland & Ellis, representing Celsius, state that there was not really any bids that would result in them making value out of the illiquid assets. So they talked about how they're going to do a reorg. Okay, so they're going to do a reorg, but very confused about the fact that they said that there were no bids that would make any value out of the illiquid assets, because I knew for certain that there was at least one. And I obviously introduced other parties to that. Now, as FTX and happened, all the big guns that some of the very large companies didn't engage in that, as we have seen, because yesterday, Tiffany Fong leaked the bids. So we got to see some of the auction bids. And so I'm not really going to talk about my own, because I've covered exactly what I would do, but everyone can now verify that I did exactly what I said I was going to do. I wasn't here to take 5% of anyone's crypto. I wasn't here to do a predatory bid to try and get hold of the illiquid assets or any of the other accusations that were flying around. I just simply was forced into a bidding process because I knew what I wanted as the 21st largest creditor, and I wanted my coins back and then all the illiquid assets put into a fund so that they could be managed and try and maximized. And as more and more assets got sold, like GK8, a lot of the strategy disappeared. So it just became like a distribution strategy rather than actually putting business in there and equity in there, as more and more of the assets were getting sold as the court and everything progressed. And obviously FTX blew up and more companies were on defense mode rather than growth mode. Okay, so you can verify that for yourself. I can say that what was leaked was factually accurate for the Bank to the Future bid. I won't go through that due to conflicts, and I'm not going to bother talking about it. But I will cover some of the other stuff if those are actually the case. So let's jump straight in to a slide presentation now. And we'll see if we can fit all this content in on time. I always go 5 minutes over. Let's see if I can get it done this time. Right, so how are we doing for time? Okay, 5 minutes in, so 25 minutes if I keep on time. Right, so today the topic is equity IOU recovery tokens. I'm going to start with what was announced from the Celsius reorg. Now, we haven't actually seen a reorg plan. Celsius told us and that they were going to release it on Valentine's Day, and we were going to be, going through the next phase on the 15th of February. And the Celsius UCC on a Twitter post of mine responded saying that this will be it. There will be no extensions. And on the 15th of February, they will step in and take over and put the plan. Tweet yesterday, the UCC are not in fact going to do that, because they said if we don't do, the alternative to not extending is liquidation. And so therefore there's very, very confusing messages that we need to find out. So what was in the Celsius reorg? What did we learn? So firstly, this is just going off what Kirkland and Ellis said, but we also know that what Kirkland and Ellis said to the judge has turned out not to be true. So far we've got that they're going to create what they call a recovery corporation. Now, this is interesting that they name it a recovery corporation. To me, when I think recovery, I'm just thinking about recovering as many funds as possible, and that this is almost like a holding company or a shell company that's going to hold those assets, and rather than selling them because the market timing is wrong, as we've been really discussing in all previous videos and on Spaces, that they're going to set up a recovery or corporation, and then they can sell them at the right time, or they can do something interesting with it. So that's what I think a recovery corporation is. I'll go through like a bullish case and a bearish case of what it might be and how I interpret it. Fortunately, they did say do what I said they would always need to do. New management. I always said the current team of Celsius, the previous executives have to go because of the misrepresentations. And the new management were always a temporary reorganization management, and Alex Majinsky's special board that he invited me to join, until I started blowing the lid on some of the things that I discovered about his activities. But they will also have a sponsor, and a sponsor will be a fully regulated. So remember, way back 6, 7, 8 months ago, in the original phase, when I was presenting a plan before Chapter 11, when they did the pause and I spoke to Majinsky and the board, I was presenting a version of a plan, and I said that you're going to need a regulated sponsor in order to do the security token part of it. But they have an SEC regulated sponsor, is what they say, that will be taking care of securities law compliance. Okay, so we know it's a new company, it's new management, and it's new licenses. Remember those? Those were the things that I said, and everyone was saying FUD, FUD, FUD. Of course, that's not going to happen. Well, it's happening. So next, they said that the coins will be held by a regulated custodian. So great. I said that we need to fix the regulations, that custody is regulated, and Celsius didn't have the licenses to offer it, as well as they didn't have the licenses to offer securities, and they only had some licenses to offer loans. So we know that there's going to be a regulated custodian to hold the coins. So they're partnering with somebody else to do that. They also said that they're going to be listing an asset share token with dividends. Okay. So the original plan that I presented to them was around a IOU token. It looks like this time will be a equity representation of the recovery corporation. I'm going to go through my experience in the companies that I've invested in that have done that to help you appreciate some of the pitfalls and some of the things that successfully worked. But they will pay out dividends. Now, this implies to me that they are either intending to take our Ethereum and stake it and pay us out a dividend or something like that, or pay a dividend every time they sell one of the illiquid assets. Or they're going to do something along the lines of some kind of cloud mining contract, put the mining company in there and pay out dividends based upon the Bitcoin that they manage to maintain versus the ones they have to sell in order to operate the organization if they can get it to profitability. They also said that there will be what's known as a convenience class. So those that have accounts under a certain amount will be given Bitcoin, ETH, and stables. So remember in my plan, I said you've got to get rid of, just focus on Bitcoin, ETH, and stables, and then just focus on Bitcoin and ETH and use the stables to buy Bitcoin and ETH at the bottom of the market. Well, that could have happened, but now they're looking at trying to get that approved as part of the plan. So this is to get out all the smaller investors, because managing these security tokens, and remember, this has to be approved. So people are getting confused. I saw people asking, well, if you use a sponsor that has all the licenses, then can we get moving straight away? Well, that's slightly different. The licenses give you the ability to issue and sell the security tokens. The custody allows you to hold the tokens. But if you are issuing a security token, it has to be approved by the SEC. So I'll go through how long that typically took outside of bankruptcy from my experience, because you have to do a full disclosure statement. You have to file that with the SEC in order to get that approved as whatever type of organization will be doing with full disclosures. They also said they'll be doing a liquidation trust. In part of my 7-part video series, I talked about packaging up the businesses, the assets, having more diversification, and having liquidation trust, and then some of the loans and various other things as well. So if it was an operating business, then there would be all of that going into the fund, as it were. But the litigation trust, this can be, pursuing insider clawbacks, various other things, litigation against Jason Stone, Alex Mijinski, and other people that have done wrong by the company, and various other things. And it will be a public reporting company. Now, people seem to get this confused with a public company. This does not mean it's listed on NASDAQ. It means it's a public reporting company. That means you have to adhere to the standards of quarterly reporting. Now Celsius is, because they've been through bankruptcy, they're probably set up in order to be able to do that. And there's no shortage of advisors that would love to take our money and charge for them to be a public reporting company. But if it's done by a regulated sponsor, then it will have to meet that requirement, which will add the transparency that's needed. And in order to meet those costs, there better be a pretty substantial business under there. And so if the business is just taking our coins and staking them, well, we could all do that on our own. But if it is managing the mining operation, then that's a substantial business. And there'll be other things as well. And so to get quarterly, public reporting company standards is a great thing. But it also will, if it's a security token, this prospectus, as it were, would require SEC approval unless there's some kind of rolled up process within the bankruptcy code where the regulators approve it. But I'll go through my experience as well. So pretty much it follows and takes many of the elements of the 7 series, if you haven't watched that already. So this went through in phases. So prior to the Chapter 11 filing, I gave Celsius a plan, presented a plan to them along the lines of some of the things I'll be experiencing that involve security tokens. As I realized what was actually happening and we started to get the Chapter 11 disclosures, then I created this 7-part video series when I understood what assets were left in the company, and published that for everybody to refine and do what they want and put together a credit-led reorganization plan. This is when we had a lot of energy, very inspired to do things, not exhausted like we are right now. Okay, so my conclusion, what is the Celsius reorg? Well, it's either one of two things. It's either what I call a tokenized liquidation holding company, which is essentially where you put a bunch of these assets into a holding company, and when the time is right to sell them, they sell them, and it's tokenized. And I have some deep concerns about the tokenized element, which I'll share with you in the secrets to what made the security tokens that I've invested in work and which ones didn't work. So it's either that, which to me sounds similar to Chapter 11 liquidation with a bit more time, where you have, advisors that can just manage the timing of selling these things, and you give it to a sponsor that will decide when to do that, and they normally charge an admin fee, which is a percentage, and they'll probably charge a success fee on profits. Remember, I presented the 2 and 20 model. We were going to get an external fund manager to do that on a 2 and 20. I imagine this may get more expensive than a 2 and 20, and the 2 and 20 was very unpopular when we proposed it, but that's what would most likely happen under this liquidation holding company structure. Or it's going to be a tokenized managed funds. Now, if it's a tokenized managed fund, that would mean that Celsius intend on doing what I never imagined they actually would do, which is keeping all the money that they said and they won in court was theirs, and essentially paying fund manager with that money again. So that would mean that we'd get no coins back in recovery. We'd get shares in this tokenized managed fund, and therefore the tokens would continue to be property of the tokenized managed fund, with no ability to redeem those tokens because all the profits would come out in dividends. Now, sorry if that's a mouthful. Let me break it down into some of the different things that I've been involved with in the past so we can understand how this all fits together when the plan is actually filed so we can see. So firstly, let's go way back. In 2012, we were talking about tokenized shares and equity. And at the time, the Michael Saylor of Bitcoin was a guy called Patrick Mine. He was the CEO of Overstock, one of the first publicly traded companies to accept Bitcoin as payment. And he acquired the team behind Counterparty, and Counterparty were building colored coins on top of Bitcoin. And we were talking about rebuilding stock markets and security tokens. But the technology was never mature enough. Around about 2014, I launched, and Bank to the Future launched, the first ever Bitcoin volcano bond in the world. And this was really mining that was happening in Iceland that used geothermal power in Iceland and cooling and power generated from volcanoes in Iceland. And we paid out daily dividends to our investors. And it was an incredibly successful, the timing was right in 2015 leading up to the 2016 halving. And we had a serious amount of hash power, and we were paying out thousands of Bitcoins, but eventually after about two years, the machines become worthless, and gradually it stops paying off those dividends. So we had experience of doing that, but we didn't do a tokenized version. Because we didn't want a secondary market that could crash out. Then we launched the first Bitcoin venture capital in 2015. This is when essentially Bank to the Future put together a holding company similar to what Digital Currency Group did later, I think in about 2016. So Bank to the Future and Digital Currency Group were co-investing in many deals. And we set up a holding company, and the purpose of that holding company invested a third of the funds and some of the funds in Bitcoin, another third of the funds in the mining the Bitcoin volcano bond, and the other third in private equity. Some of the companies that we invested in were Abra, BitFinex, Exodus, Kraken, BitPay, Circle, that launched USDC coin, and various other companies. We got about a 600% return from that portfolio, and all the dividends were paid out, daily dividends again, to all of the investors through the mining operation. The mining operation didn't benefit from any equity value increase because we were just mining until it was no longer profitable. And after a couple of years, it was no longer profitable. So it stopped paying out those dividends, but it paid out the dividends when one of those companies matured. Okay, so then we started hitting 2016 when I invested in a company called the DAO. So I invested in the Ethereum ICO. I still haven't sold those tokens, actually, still in the Ethereum ICO. And put a percentage of some of my ETH into the DAO in 2016. This was meant to be a tokenized venture capital fund. Shortly after launching, they tried to do too much. It was one of the first smart contracts on Ethereum, and it was created by many of the founders and the Ethereum Foundation. It led to a 50 million hack. The SEC then reported it for being an illegal security, and they decided to reverse the chain in order to refund all of the insiders and the pre-mined Ethereum founders. And the original chain stayed as Ethereum Classic, and a new chain was created called Ethereum. And the SEC published saying these are definitely securities. And we thought that was it. We thought that was done with the whole side. These things are going to be registered as securities. So then we had the BitFinex hack. Now, this is where I'm going to go through some of the very important secrets that made the BitFinex hack recovery token work, so that we can learn from it. And then I'll go through some of my other investments, some that didn't do so well and others that did well. We've got about another 10 minutes for me to remain on time. Okay, so rewind, it's 2016. We're going through our second halving. The first halving in Bitcoin happened in 2012, the second in 2016. Mt. Gox was a disaster for our industry, and BitFinex was one of the largest Bitcoin exchanges, and it did an integration with BitGo, a custodian, tried to make it where everyone could prove their own wallets, so separate it all, and there was an argument between BitGo and BitFinex, because a hack led to the draining of $72 million worth of Bitcoin, which was 119,000 Bitcoin at the time. I released a video. You can check it out on YouTube. Bank to the Future released a video on its YouTube channel explaining how it was worked and how it was structured. And we still have a secondary market for those that want to buy and sell those with a price floor. Very, very important feature. Price floor at the very last price of the last funding round. Something that has made it very tricky in the tokenized equity industry. I'll go through that as we go through. Right, so here's the secrets of what made it work. And this is very important because if it turns out that this token is going to be issued to people, remember how this happened with Celsius. Alex Majinsky misrepresented an incredible number of people have taken their lifetime savings, remortgaging their house, and investing in this product. So this is some people, everything they've got. So we can't mess around with this. So if we're going to be issuing some kind of token, it's far too important to not learn, not have Kirkland and Ellis and a bunch of people that have zero experience in security tokens issuing these things. Because I'd like to tell you the reality of it, not based upon a pipe dream, not somebody that's mis-selling you, a pipe dream, but really based upon the reality of all the experience of being involved in these things on the ground level. So the BitFinex, what made this one work? It was a 16x return and a whole lot more for those that bought at the low and bought it. Essentially what happened is they dollarized the whole. So the first thing BitFinex did is they said, we've lost it. And they said approximately 70% of the coins are yours. You can withdraw them, you can have them, you can do with them as they choose. They didn't say we're going to take the 70% of the coins. They said, but we've lost 30%. And for every dollar, we're going to issue you $1 worth of this token, which was called BFX. So the BFX was the token. It doesn't exist today because it was fully diluted and it was burnt out of existence because of that. So what made it work? Well, firstly, it was debt in a profitable company. That was key. There had to be ongoing revenue that meant that we could have faith in the ability for BitFinex to repay the token. Now, everyone was very skeptical at the beginning, but it did shortly after, within the first year, from its profit, repay $22 million of the $72 million. So it was backed by, going very fast into profit. That was one of the secrets as well. It was equity backed. What this meant is that we valued BitFinex at the time at $200 million. It's now a multi-billion-dollar unicorn, but at the time we valued it at 200 million, which felt like a reasonable valuation given the circumstance. But no matter what the price of the token was, So if it was trading at 30 cents, you could still convert it for $1 of equity. So rather than tokenizing the equity, the token was a debt, and it represented all the debt, but it was, backed by a profitable company that shortly went back to profit, and then you could convert it into equity, which meant a very important feature of this. There was buy demand for the token from those that wanted to invest and get discounted valuation into the company. So there was a pitch on Bank to the Future where you could convert the BFX debt token into equity. No matter what price it was trading at, you could convert it at $1. So this created a very important feature of making it work. The other thing was the market timing. It was timed into the post-July 2016 halving that went into the 2017 bull market as a result of BitFinex not being a Mt. Gox disaster. So the timing was very important leading into the market. There was speculative money around and people were in that type of mode, even though it was a disaster at the time. The other secret that made it work is that there were buyers of last resort. What does that mean? There were people that were willing to invest in the equity of BitFinex at 200 million, but they were willing to buy up as many tokens. If people wanted to sell it and they was crashing down to 30 cents, then people could essentially either debt investors or equity investors. The equity investors could get into BitFinex at an $80 million valuation. This ended up being a multi-billion-dollar unicorn that traded, from 30 cents to a high of $16. So, that was an incredible return for the buyers of last resort. And they were, pre-baked in. They were ready to buy and provide that liquidity. There was also pre-baked in debt investors. If they believed that BitFinex could recover, they were willing to get a 70% discount, buy the token at 30 cents, and with the belief that it could be repaid for $1. Just like, the claims traders in Cherokee and various other companies have been speculating, they were baked into the process. There was also a 1-year lock-in and a price floor. So we weren't going to make it tradable on Bank to the Future until 1 year so that they had time to recover to prevent all the people dumping. And also our secondary market has a price floor. There's a very reason for that, because liquidity and private equity are a really bad mix, because people get impatient and they want to sell just simply because of the price of impatience, especially after a distressed situation. So the price, the 1-year lock-in was an important feature, and the price floor had to be there. So people couldn't sell it at a discount to what they converted it in. And there was no retail dumpers. So there weren't people that really needed the money in general, as we see in Celsius. So those were the secrets that make it work. Now, let me cover some of the other case studies so we can compare it. So now we recovered from that. It was one of the most successful investments. It paid out hundreds of millions in dividends from profit. The price of the token on the secondary market, the equity on the secondary market, and we didn't create a token that would lead to it crashing. So the next part was in 2016. We invested in a company called Exodus. And this was on Bank to the Future. It was May 2016, and it was at a $3.2 million valuation. It was an early stage company that was creating a wallet. Now, think about that while we move over to the other thing. I invested in Exodus, and I also invested, Bitcoin Capital investors as well. I invested in a company called Blockchain Capital. Now, Blockchain Capital was the most reputable venture capitalist. So when we were talking about in our plan getting a sponsor to manage under a 2 and 20, that's how companies like Blockchain Capital work. And they've been investing successfully in the industry. Met them the same time, been involved and worked with them. And so these are professional fund managers that have been investing in the industry. I was a seed investor in their first tokenized fund, Blockchain Capital, that they launched in 2017. So those are two deals that we can now compare and understand so that we can learn to make sure we get this right. So at Bank to the Future, we also did a funding round for a company called Securitize in 2018 we were investing in it to build out the tokenized equity and securities market. And so Securitize had the broker-dealer license, the SEC, the ATS, everything that was needed, and progressed. Then I met the guys, Barry Silbert brothers, Alan Silbert. They started to launch INX and spent a couple of years trying to get the licenses and acquiring the companies in order to do tokenized securities as well. And that happened throughout 2019 and 2020. And then they launched their first IPO for INX as well. So Exodus now came back and decided, now Securitize was launched, to take their hundreds of thousands of investors, they were getting millions and millions of users, and get them all to sign up to Exodus. So they onboarded like 400,000 users or something like that, because they connected the Exodus wallet to the Securitize regulated security token exchange. And they issued the EXIT token. Now remember, we invested at 3.6 million valuation, the Bank to the Future investors. By March 2021, this was done at a $750 million valuation. However, they had to get it approved by the SEC, because even though Securitize, the exchange, was approved, the offering had to be approved by the SEC. So that took them approximately 9 months, and they had to put together a very, very long document, but they managed to get it out of the door. And then they launched it, and they raised approximately $75 million through their wallet connected to the Securitize platform. Now, at this point, the shares on our platform were about $27. However, they did something that I kind of told them not to do, which was the security token won't defend the price of your company, because the impatient investors will dump it. And sure enough, if you look at the price on Securitize, they basically raised the 75 million, got approved to list on Securitize. And then you can't really see that chart very well, but the price went from about $27 for the offering to approximately $3. Why? Liquidity is low. So security tokens have very low liquidity. I believe in the future of the industry, but to say that there is going to be the ability to sell from day one is certainly not how security tokens work. And if many people are trying to sell because they just want to get out of it, this is not going to work well. That's what happens when you do an equity security token. So what are the other types of ones? Well, remember blockchain capital? Well, I invested in a few more as well. Now, here's the thing. The underlying value of the company, they report it at $72 for the underlying value. Now, our equity in the B shares that we hold is still valued at that, because just because people are trading at a discount, they're trading at a significant discount, around $3. So it's a big problem. The other one is blockchain capital. So I invested in blockchain capital. Now, the net asset value, this is a fund, remember, a tokenized fund. Now, the net asset value based upon their quarterly reports is about $18. So I invested at $1, got an 18x return on net asset value. But the token, the security token on blockchain capital, is listed on Securitize, but now it has to trade at approximately around $2 to $3 or at the moment. So because of low liquidity, you've got a significant discount by tokenizing to the net asset value. This is one of the challenges of the industry. It's why when we did our secondary market at Bank to the Future, we introduced the price floor. So if Celsius are going to be using security tokens or equity tokens or fund tokens, then please make sure that we design this correctly. And because so many people's life savings are on the line, we cannot be reckless. We can't mess around. And I really ask the question, if we can design this correctly from a lot of this experience, please make sure that this gets to the powers to be. I have introduced the contacts to Celsius of the types of teams that understand and have this experience, so that this isn't being designed by a bunch of degens that have no experience, that think that tokenization is going to work if you don't design it correctly. Okay, so that brings us to the Celsius reorg. Whether it's a tokenized liquidation holding company that I see no reason why you would ever need a token other than trying to tick a box, or it's going to be a tokenized managed fund, let's make sure it's designed correctly based upon experience rather than just buying into this pipe dream and completely misrepresenting. Okay, we are at the half. I'm already 5 minutes over. I'm going to cover more details maybe on this next week, and I'm going to stop right here. But as I said, Celsius and Kirkland & Ellis said in court to the judge that none of the bids would maximize or give people advantage of the illiquid assets. And yet, Tiffany Fong recently leaked the bids, and I'm not going to go through those right now, but there were bids that took advantage of those assets. So people could, in fact, the model, I'm just going to go very briefly, just for 1 minute, rather than going through all the features. But NovaWulf, who I haven't come across before, their leaked one, essentially, I'm not going to go through these because I'll go in more details and we can take it over to the AMA. But essentially, it's the same as what seems like the Celsius model is proposing. So why were we not given the opportunity to vote between somebody else doing it and Celsius doing it? Is it because Kirkland have a different strategy? I'm not sure. I don't know the answer. Binance US just wanted to take over the tokens, similar to Voyager. I won't go through the details. It said it won't do Cell token, it won't do FTT tokens, but it will just give people a way of getting hold of their tokens. Now, it doesn't mean that you need to get rid of the illiquid value. It means you need someone else to do the illiquid value. Cumberland kind of put together a bit of a predatory bid. From what I can see, it was a 15% discount on your crypto assets. So whatever haircut we get a further 15% haircut from Cumberland, no sell included, none of the other illiquid assets. And Galaxy's one was another one. It looked like there was a 17% haircut from what I can tell. Correct me if I'm wrong, it was just how I interpreted it. So our bid obviously was giving everyone their coins with no fees, no discounts, just whatever the haircut is of what Celsius lost, and giving everybody SPVs, which is what we do all the time, in all of the illiquid assets that can be on a price-floored market. Okay, so I've gone over. I'm going to head over to Twitter Spaces right now. I've gone 7 minutes over. 8 minutes over right now, and we're going to start the AMA, and we can go through deeper into this. Love to get your response and thoughts about that and what the next approach is. So I'll head over. Just a quick thing, as I always say, remember, we're going to be doing our High Net Worth Investor Masterclass this year. It's one we do every year. For anyone that's a certified high net worth investor, we spend about a whole week online going through everything that's changed, reviewing what we invested last year, and going through everything. So make sure that you have certified your account on Bank to the Future. High Net Worth Investors Masterclass is for non-US high net worth investors. You can get hold for free of the 2020 Masterclass. If you're not a high net worth investor, just go to retirementplanb.com. We're going to be doing new websites as well for /book. You can see there, you can get the first book in the world that include Bitcoin, my published book, and previous masterclasses for those interested as well. Okay, let's jump over to Twitter. Let me just give them a face before we do that. So always remember, you are alive at one of the most interesting and exciting times in financial history. If we do not get this right for Celsius creditors, some are going to get wrecked, others are going to do really well, and I want to make sure that whether it's Celsius reorg, whether it's a UCC takeover, whether it's some of the other bidders, that this is designed correctly and we do not mess around with all the people that were misrepresented, and make sure that we do this with the right level of risk disclosures, realistic expectations about how long these things take, none of these extending BS deadlines, and lies in court saying that there was no bid that took advantage of or allowed people to get access to the illiquid assets. and no UCC saying, well, we promised that the 15th will be the deadline, and now we're going to change that. So let's head over to Twitter Spaces right now. We do this with peace, love, and unity, and I will see you on Twitter Spaces and see you in YouTube next.